I think there's a lot of people that think it was necessary, and the market reaction yesterday is a good example of that. But look, Wall Street finished, the markets finished yesterday at a level that was higher than every single Wall Street house had predicted for the year. So we had already run ahead of what anybody thought the market was going to do for this year. So the Fed doesn't pivot like they did unless there's going to be concerns. I agree with what Michael said. And then you get some validation of those concerns. You get the European data, which is terrible, the German bonds, which have gone back to negative yields. And now you're also entering this time frame of year that people need to be aware of, the share buyback blackout period. It really starts to ramp up on Monday, and we're going to have it for a few weeks. And buybacks have been a big part of what's driven this market higher. Finally, you get the inverted yield curve. I'm not terribly worried about that yet, because as the curve inverts, historically, the market does pretty well for a while. Secondly, the Fed has some tools in their toolbox to address that. They could use expiring maturities and buy the short end of the curve and keep that curve positively sloped if they so choose. So we think, and finally, we think the economy is going to start doing a little bit better in the second quarter than it is in the first, and M2 money supply is starting to validate that. So yeah, I think we might back and fill here. The next few weeks could be pretty tough. But beyond that, I think it's going to be an okay market, if not a runaway market.